Okay, in the second part of Fool's Gold, we're going to talk about what Gillian Tett calls perversion. And this is in the late 1990s, we know that the Glass-Steagall Act was repealed. And we had the Commodities Futures Modernization Act, which said that swaps are not futures or securities, and therefore they could not be regulated by any regulatory body. And not only were they not passing laws to regulate commodities or swaps and futures, they were actually passing laws saying they could not be regulated. So we're heading down a similar path like we saw in the number, where people who don't want to be regulated are going to start doing nefarious things. So in 2002, we know that technology bubble bursts and interest rates are low, and 9/11 happens. So it puts the economy in a funk. And consequently, we have fund managers and investors, as we find out on page 93, were frantically looking for ways to boost profits. So banks like JP Morgan devised a host of new tricks for offering investors better returns, which invariably revolved around creating products that employed more leverage, in other words, more debt, as well as more complexity and risk. And this freewheeling experience centered on repackaging various credit into investment offerings. So that's what we're going to see is they're creating these credit default swaps, and they become increasingly more complex, and people don't understand them. And we're going to talk about the problems that they create. So originally, when they're creating these CDOs, they're constructed out of conforming mortgages, and conforming mortgages are just the mortgages that we traditionally give to an individual. So somebody would come in, they would put 20% down on their house, they had a good credit report, they had stable employment history, and the loan was not a jumbo loan. It wasn't above a number, predetermined number, like 600,000. And so these were called conforming loans that met the high credit standards of Fannie Mae and Freddie Mac. But in a push to sort of have everybody live the American dream, politicians and others encouraged lenders to lend, to be more liberal in their lending policy. So in the late 1990s, a swath of new mortgage lenders and brokers entered the field who specialized in subprime loans. So these subprime loans, obviously subprime means below prime, or below what's considered high credit standards. So loans were increasingly extended to borrowers with bad credit history. And again, now why would they do that? Well, for a couple reasons. One, like we mentioned, politicians were encouraging them to give loans to people with maybe poor credit history because they were encouraging. They wanted people to be able to buy homes. They didn't want to have to, everybody have to put 20% down and have worked at a job for a long period of time and have decent credit. They wanted people to be able to buy homes. And not only that, the banks wanted these mortgages. They wanted these loan originators like Countrywide to make these mortgages so that they could then buy these mortgages from them and package them into CDOs. So it's sort of two things: politicians encouraging lending, and then the originators who weren't going to keep the loan. They didn't really care how risky it was. They just wanted to put that loan together, find somebody who could sign on the dotted line for that mortgage so they could sell that mortgage to an investment bank, and that investment bank could package it into a CDO. So getting back to this quote in 95, it says remarkably, that meant that almost half of all mortgage-linked bonds in America that year were based on subprime loans. So they're giving out so many subprime loans, but mentions in the book that these subprime loans were like pixie dust to yield-hungry investors because they got even better yields on these CDOs because the investors are the borrowers that borrowed the money for these homes. Because they were subprime, they had to pay higher interest rates. So that means the CDOs that were a package of subprime loans could offer even higher yields on the bonds because the mortgage holders were paying higher interest rates, and they could charge a higher premium they could pay a higher premium on the potential that they might default. So for that default insurance. So what about default risk? So aren't these folks that have subprime loans, aren't they more likely to default on their loans? And mentions on page 97, the drive for high yield through CDOs was all based on the fundamental premise that the default risk of bundles of mortgages had been virtually erased by the process of bundling and then slicing them into tranches. So the chance that the bank would ever take a hit from it seemed so remote as to be unfathomable. And so there was a lot of thinking about why people didn't normally default on their loans, on their mortgages. So first, even if they're subprime lenders, they don't have great credit history, they don't have a lot of equity in their home, it's still their home. And traditionally, people defaulted on their credit cards and their cars and other things before they defaulted on their homes because they needed a place to live. Their home was their biggest asset, and they usually had some equity in the house. So it didn't make any sense to default on it because then they would lose their own equity in the house. So traditionally, there hadn't been a lot of, at least it was perceived that there hadn't been a lot of defaults on mortgages because people might default on other credit like credit cards, but they were increasingly less likely to default on their house because everybody wanted a place to live. So the last thing you stopped doing was paying your mortgage. So they didn't really think that there was much risk, even though they're subprime lenders. They were packaging these mortgages full of subprime lenders. We had never seen really a crash in the housing market like we'd seen in the crash in the stock market. And so we didn't really think that there would be widespread crashes in the mortgage market. And we thought, yeah, here and there might be somebody who doesn't pay their loan and defaults. And there might be somebody who got a loan that shouldn't have, and they wind up defaulting. But if in a package of loans that and if those mortgages were in the package, and that CDO package came from all over the country, yeah, you might have somebody default in Texas and maybe somebody default in Florida, but they're not going to default across the board in this entire CDO. And the CDO is broken down into tranches, so it had the senior, the mezzanine, and the junior tranches. And the junior tranches, because they were the ones whose money would get used up first if there were defaults in the mortgage market, but they were getting a much higher risk. So they're being paid to take that risk. And so if you're paying somebody to take that risk, you're not really that concerned about them. And so they thought they had this whole thing figured out. The people who wanted to take excessive risk to get those high returns could buy in the junior tranches. The mezzanine tranches, it was a little less risk, and then they felt the senior tranches were extremely safe. And so the rating agencies, they would look at this. They didn't have a lot of data on mortgage rates and mortgage defaults, specifically the correlation among mortgages. So they didn't really know if one person defaulted, if that made somebody else more likely to default. And correlation is critical to determining, whether a CDO would go down, because if the mortgages in those CDOs were correlated, if it was more likely if homeowner A defaulted, that homeowner B would default, then the whole CDO could essentially be like a set of dominoes where one defaults, that means another defaults, and another default. And again, they didn't really know if there was correlation. And correlation's important to know from an insurance purpose. If you thought about what they were originally doing with credit default swaps when they were putting in when they were using corporate loans and bundling those and then getting insurance on those, well, we had a pretty good idea of historical data on how often corporations default. Whether it's in a recession or a depression, we sort of know blue chip companies, how often they default, and what's the likelihood if one company defaults that another one defaults. So, for example, if Ford Motor Company defaults, there's probably not a high likelihood that Microsoft's going to default. But if Ford Motor defaults, the corporations that supply Ford with steering wheels and engine parts and other things, they're probably highly correlated with Ford, so they're likely going to default. So you could easily determine that correlation and figure out what's the likelihood that a package of loans, either if one of them did default, if it would lead to others defaulting, and that helps you price the insurance that you would need and the premiums you want to pay on those insurance. Well, for mortgages, they didn't have that. They didn't know if mortgages were correlated. So if and they, in some ways, they assumed that they weren't. So if homeowner A defaulted on his loan, it wouldn't make it more likely that homeowner B would. But they really didn't know. And if you think about correlation, there is a possibility that if homeowner A defaults, that homeowner B is also going to default. For example, if you go back to to the Ford scenario, if let's say that Ford defaults on its debt and goes bankrupt, and homeowner A and homeowner B are both in Detroit and they work for Ford, then it's likely that those default rates are correlated. But if homeowner A is in Texas and homeowner B is in Detroit, then maybe if Ford defaults, maybe homeowner A is likely to default, but not homeowner B, the one in Texas. But they really didn't know. And they didn't know if, what if homeowner A and homeowner B lived in different locations, but maybe it is possible that mortgage rates around the country, mortgage defaults around the country are correlated. So they didn't know any of that. And so consequently, they were making decisions on these CDOs and how to price them basically on bad information or information that they didn't have. But it was sort of based on historical conventional wisdom that people weren't going to default on their homes. Once they could get into a home, they wouldn't default on it like they would with credit cards or other things. So the other things that banks were doing is they're creating structured investment vehicles. So these were different than the special purpose vehicles, the SPVs. The SIVs, they were used to move deals off the books of banks. But unlike SPVs, the SIVs, the structured investment vehicles, were not independent of the banks themselves. And so the banks were providing funding to these SIVs. And these SIVs actually should have been consolidated on the bank's books. But regulators didn't know banks were setting up these SIVs, these structured investment vehicles, and that any of the funding of these SIVs, they were providing the funding, and any debt that the SIV raised should have been back on the bank's book, because if the SIV defaulted on that debt, the bank was going to have to come up with it. So they weren't really separate entities like the SPVs. The SPVs were shell companies that purchased banks' assets, and their balance sheets were they were correctly off the balance sheet of banks. But the SIVs were not. They were still part of the bank, and they should not have been accounted for separately. They should have consolidated the SIV's books with the banks. But they were getting away with it back then. So the rating agencies. They would get this. They would get these CDOs, and they would have to rate the bonds related to the CDOs. So the CDOs. So the CDOs were a package of mortgages, and the interest that they were paying on those mortgages was going to go to the bondholder of the CDO. So the bondholders were selling bonds. They were like the SPV was issuing bonds. The bondholder, like we learned in the first set of slides with Fool's Gold, the SPVs were selling bonds to bondholders. And let's say they sell $100 million worth of bonds to the bondholder. Then the bondholders would then be on the hook in case any of the mortgages that were in their bundle that they were providing insurance for. So if any of the bank's mortgages that were in this bundle, if they defaulted on their mortgage, then they would take it out of the money that the bondholders loaned the SPV. And so the bondholders would get back less money on their bond. They'd get less principal back if any of the mortgage holders defaulted on their loans. But the bondholders got high returns on those bonds because they were being paid with interest from those bondholders, and they were getting a premium for allowing the proceeds from their bond, the principal that they used to buy these bonds, as the principal was insurance against in case these mortgages defaulted. And they were getting these high interest rates on these bonds, these high yield bonds. Now, the rating agencies had to determine if these bonds that were basically collateralizing these mortgages were high yield or low grade bonds. So the rating agencies would have to rate them. And so to be able to rate those bonds and what's the likelihood that you would get your principal back on those bonds, they would have to look at the underlying list of mortgages that these bonds were providing insurance for. And then they would have to determine, are these mortgages correlated, and what's the likelihood that these lenders are going to default. Now, the rating agencies went on conventional wisdom that mortgages traditionally don't have a high default rate, and that they weren't correlated, and consequently they were giving these bonds AAA ratings or investment grade ratings. And when they did that, that allowed fund managers and managers of pension funds and others to be able to invest in those AAA rated bonds or those investment grade bonds. Because like pension funds, for example, they might have limitations on how risky a bond they could buy. So the rating agencies, it was key that they actually rate those bonds accurately on how risky they are. And if the underlying data on the mortgages isn't good, then they really couldn't do a very good job of rating those bonds. And it also turned out that the rating agencies use calculations. They have algorithms that they would use to calculate what the risk was for these bonds. And the banks were able to basically reverse engineer these algorithms so they could put a portfolio of loans together that they knew the rating agency would give a AAA rating to, at least for the senior and the mezzanine tranche, maybe not for the junior tranche. But they weren't as worried about selling the junior tranche because they knew that there are always going to be high-risk investors out there that would buy the junior tranche. They wanted to make sure that people, that pension funds and mutual funds and others that were looking for safe investments would be able to buy these junior and mezzanine tranche bonds. And since they were able to basically reverse engineer the algorithms that rating agencies use to rate these bonds, they knew exactly what they needed to do to get these bonds, to put together a portfolio of mortgages that the bonds that insure these mortgages would be able to get a AAA rating on. And it mentions in page 20, the aim was to get as high a rating as possible with the highest level of risk, because you want to get the AAA rating but still have a risky bond, because that way the bond would be able to get, it had the best of both worlds. It had an investment grade rating, but it was getting high yields because it was still a higher risk bond, because the bond in many of these were providing insurance on subprime loans. But again, the conventional wisdom was that even though these loans were subprime, the homeowners were still people who could pay their mortgages. And conventional wisdom is that people just didn't default on mortgages. That's just not something that happened. Like I said, we hadn't really seen up until 2008 a crash in real estate markets. You know, like we had seen crashes in the stock market. So people thought real estate investments were pretty safe, especially for mortgages. And so, again, the aim was to get as high a rating as possible at the highest level of risk so the product could produce all-important higher investor returns. It mentions that in banking circles, this game was known as ratings arbitrage. And it was arbitrage because the rating didn't actually match the risk of the bond. And that was on the rating agency. But the rating agencies were getting paid, you know, sometimes $500,000, $750,000 to rate these bonds. And so they had every interest, you know, every financial interest to make sure that the banks that were going to sell these bonds got the highest rating possible, because that's what they were paying for to the rating agencies. So again, this is called rating arbitrage, when the bond rating doesn't actually match the level of risk. So JP Morgan mentions that on mortgage-backed securities, they missed the boat purposely. because they didn't believe they had good enough estimates of correlation to measure how much risk was actually being diversified away when they put these bonds these mortgages into these CDOs. So JP Morgan sort of looked at it as like, this is crazy. We did the first one, this first bistro a long time ago, but we don't really know if we package these mortgages together into a CDO and then sell bonds and have these bonds, provide collateral for these mortgages. We don't even know what the premium we should pay for these mortgages because we don't know how likely is these individual homeowners are to default, and if one of them or two of them default, is that going to create a wave of defaults because mortgages are correlated? They said we just don't have the historical data to make those decisions, so we don't want to get involved into a potential risky game that we don't understand. But because Goldman Sachs and Bear Stearns and Lehman Brothers and everybody else was doing it and getting these and making a lot of money doing it, Jamie Dimon, the head of JP Morgan, said, you know what, we got to start doing this because housing prices are going up from 97 to 2005. Housing prices rose 80%, and then Jamie Dimon decides we've got to get involved. And he says securitization is a priority because we got to start making up some ground like these other banks that are making so much money doing these things. So for a short time they do get involved, but then by 2006, inexplicably we start to see defaults in subprime loans. So when it says inexplicably, it's inexplicably related to historical standards, but it's not inexplicably based on the types of people who were getting these subprime loans. It should have been predicted. But again, inexplicably, because there wasn't an increase in interest rates, there was an economic slowdown, which are historical predictors of why people default. And so now people are defaulting during what seems to be a good economy, and people are baffled by that. So JP Morgan, who originally thinks they need to jump in, they get a little skittish now, and they get in for a time, but then eventually pull out, and they pull out for several reasons. So Winters and Zetlin decide that they can't make money doing it. And it's partly because if you think about these CDOs as a product and a bank as a manufacturer, if you manufacture a product, you have to buy the raw material, and then you put the product together and you sell it as a finished good. Well, the raw material for these CDOs, the raw material is mortgages. And if every bank's trying to snap up every mortgage out there so they can put it into a CDO, the cost of the raw material, the cost to buy these mortgages from the mortgage underwriters like Countrywide is getting too expensive. And so they can't make enough money when they actually package these mortgages together and sell the CDO. There's not enough money to make. Profits are too thin. It's just like manufacturing any product. If the raw material price goes up, you can't make money. So JP Morgan jumps out, and here it has the logic. The business had fallen victim to a vicious cycle. Banks and other lenders were issuing more and more mortgages, which were riskier and riskier, so that the loans could be repackaged into more and more CDOs in order to make up for declining profits. So we just get this cycle of banks buying mortgages. And again, so in the second bullet point mentions that demand for mortgages for CDOs was pushing homeowner lending rather than homeowners' demand for loans. So it's not like homeowners were just showing up at Bank of America and Countrywide and asking for loans. Everybody who could legitimately afford a house had a house. So the only way to get more loans was out there to create more mortgages that banks could buy for CDOs. These loan originators, banks like Wells Fargo and Bank of America and Countrywide who are originating loans, they have to convince people to go out and buy homes, right? And so they were basically looking the other way on credit standards because they wanted to get anybody and everybody who would be able to sign a mortgage note to sign it so that they could take those mortgages and sell them to the investment banks. And so banks had to offer better and better subprime rates in order to get homeowners to be able to qualify, because everybody who could qualify for a home had it. So the only way to find more homeowners is to reduce the lending standards. And so consequently, we had riskier and riskier mortgages. I mean, they were creating subprime mortgages where you only had to pay your interest, right? You didn't have to pay any principal for like the first 5 years. They were trying to do anything and everything that they could to get anybody to qualify for a mortgage so they could sell the mortgage. And the loan originators like Countrywide, they didn't care if that loan was risky because they weren't going to keep it. They were going to immediately sell it to an investment bank, And so they didn't care that investment bank got paid back. And the investment bank didn't care because they packaged it into a CDO. And if somebody defaulted on it, then they had these bondholders who had loaned them money who they were going to use the principal on those bonds to recover any potential defaults. So the bondholder, they thought they were covered. They didn't think these were risky loans because they got subprime. They got AAA rated bonds that they thought they were buying. And so all of the risk got pushed onto these bondholders who thought that they were buying investment grade investments, right? When they were buying these bonds. So it becomes this vicious cycle. And then in the regulators, what were they doing? Well, they were doing the same thing that regulators were doing in 1999 before the stock market bubble crashed. There wasn't a lot of volatility. You had Bernanke, the chairman of the Fed, so Greenspan's gone now. Bernanke's taken over. And Bernanke, he was an economist who had done his dissertation on stock market crashes, so he seemed to be the right person to have in place during this time period. And he basically said we had entered this period of great modernization. So again, kind of going back to when Greenspan fixed the market, fixed the economy scare during the long-term capital management debacle, and when he put together that consortium of banks and then lowered interest rates. Bernanke had this sort of same feeling that things are okay. We've sort of figured out how to manage monetary policy, and inflation's not an issue. So central banks like the Fed around the world have crushed inflation. There's a saving surplus in Asia, so there's people looking to invest, and the market seems to be under control. Now, some international regulators didn't feel the same way Bernanke did, and they were nervous. But again, you have these American economists who are free market thinkers. Even though we'd had the dot-com bubble and all the frauds, we still have these free market thinkers out there thinking that everything's going to be fine. And so the international regulators, who were a little bit concerned about what was going on, couldn't convince the Americans that that there might be some cracks in the foundation. And Geithner, who had sort of lived through the crisis in 2000, 2001, he was getting concerned about counterparty risk because he realizes that these CDOs and these swaps, these interest rate swaps, and all these other things, they're not being traded on an exchange. And what happens if, for example, these banks are getting insurance they're buying default insurance, but the insurers can't pay up, right? So it comes time that mortgages are defaulting, or the corporations are defaulting on their loans, and the people who are supposedly insuring these loans can't pay, right? Because they're not traded on an exchange. They don't know. There's no broker or anybody else who's a member of the exchange that they go through to sell these CDOs on an exchange. So there's nobody there sort of to keep track of, will somebody pay up if people actually default? So Geithner's worried about that, and rightfully so.